Hey, everybody, and welcome to this special emergency episode of the Blind Ambition with Jack Kelly. It's your friend Rick from Blind, and today I've asked Jack to come on the show and kind of break down this headline. So he's covered in Forbes. Goldman Sachs is having another round of layoffs. It's going to be about 3% to 4% of the bank's global headcount, which ends up being around 1,300 to 1,800 jobs. And the kicker here, which is why I want Jack to kind of break it down for us, is it's connected to the annual review process. And the bank, the executives have come out saying, hey, these folks that are getting cut, we're doing it because of performance reasons. It's not a typical reorg layoff, it is performance focused. Now, did I get that right, Jack?
Yeah, so this is what I think is so unfair with Goldman. It's not just Goldman. For today, we're talking about Goldman Sachs, top tier investment bank, really well regarded, considered one of the, top tier investment banks there is. And
Right.
what happens on Wall Street, it's kind of cold-blooded. You'll have every year, sometimes a couple of times a year, cull the herd. So what happens, they'll take supposedly the low performers, the people who feel are not up to snuff and just let them go. And it's harsh, it's cold, it's brutal. And not only that, it's not just the layoff. The challenge is this. So let's say Rick and I are at Goldman Sachs and we're let go. But we're let go after the press is showing that they're letting go a certain amount of low performers, non-performers, words to that effect. So if we're going to now go and interview at Morgan Stanley or interview at Deutsche Bank or a hedge fund or a private equity shop, the companies aren't stupid. They're going to say, why did Jack and Rick get chosen to leave the company
Wow.
while there's 40,000 people at the company already? Why did they leave? Why were they asked to leave? Is there a problem? Is there an issue? So now only do you lose your job, but now you have this stigma attached to like, hey, you're a non-performer, you're a low performer, you're not up to snuff. There's something wrong, you didn't do something right. So now that follows you. So imagine going to an interview and the interviewer at a Morgan Stanley or another high level, company, they're gonna, human nature. They're gonna be curious. Are we taking a leftover from somebody? Is this a bad person? Is this someone who did something really bad? Did they do insider trading? Did they do something, questionable? And now that sticks with you. So Rick, right? It's I don't think it's like that in the tech sector, but it's a really cold way, in my opinion, really cold way of doing it. Now, if they didn't put on the imprimatur of low performer and words to that effect, okay. But once you say that, it plants that seed for other people to look at you in that way, right? So that just seems like a double tap of like negativity, losing a job, now losing a job, but like having this like prejudice against you because maybe it was your fault, something happened.
So it's like, not only do I not want you, I'm going to screw you so that
Right.
you can't get a job anywhere else. Like it's the scarlet letter that's going to
Yes.
stick on your resume.
Oh my, that's a great way to say it. It's a scarlet letter. Like, hey, beware of this person with the scarlet letter on it or this like insignia on it. There's a problem. Watch out for this person. And and then you know what? Think about this. This is what's also so crazy. This is what drives me nuts. If you have 1,000 people getting laid off, they make it
Right.
sound like it's nothing. Oh, it's only 1,000, 1,300 people. Oh, only 1,000, 1,300 people. where the hell are the managers? Like, if there's 1,000 people that are not performing up to a certain level, whose fault is that? Wouldn't you have to point to the managers and say, wait a minute, are you doing your job? Are you training them? Are you coaching them? Are you mentoring them? Are you reskilling them? Are you, doing everything you can to bring them up? But maybe it's not the worker's fault. And this is another reason why it's so frustrating for people, because it could be the managers who suck. Like, why do we absolve them of everything? Like, if they were good managers, presumably they would see that their people aren't really doing well. So they'll do everything in their power to bring them up so they don't have to be called. Right. I mean, we ignore that part.
I mean, I wonder, and so this is my days when I wanted to be a lawyer, so
Mhm.
young Rick time.
Yeah.
But a lot of these big law firms, they have these so-called up or out policies
Mhm.
where, after 5, 7 years, if you're not a partner at the law firm, you're let go from the law firm. I wonder, is that the case at some of these Wall Street banks, Goldman, Morgan Stanley, what have you? Do they have a similar practice in terms of, hey, if you've been at the firm for this couple of years and you're not on that partner track, or you're not an executive yet? I mean, is that how they're kicking these butts of the managers? Is it in another roundabout way? Or does that culture not exist? Or does it exist in a different way on Wall Street?
That's a really good question. What happens is this: with Wall Street, there it's similar to the way you're describing, but a little different.
Okay.
So let's say you're you're an investment banker, right? And you're doing deals, you're doing mergers and acquisitions, you know, you're doing underwriting for IPOs, what have you, and you're the hot shot, you're doing great. But then all of a sudden, some years go by, maybe you lose some clients, the economy is different, maybe not so great. So
Right.
now let's say Rick and I were like hotshot young investment bankers, but due to the economy, due to other, events, due to our age, maybe things are changing. And now it's kind of what you're saying about the law firm. They may tap us on the shoulder and say, hey guys, you had a great run, but we're looking at the numbers and we're paying you, $1 million a year and you're not really generating that much. So, sorry.
Bye. Oh
Yeah,
boy.
yeah. So so it's sort of similar, right? A little similar to that, where um, you go past your expiration point, like it's your expiration date is like, all right, you were really good. You really helped us. You made a lot of money, but you're not making us money anymore. So see ya. Take care.
Yeah, it just strikes me of this kind of culture of what have you done for me lately? Right? There's
Yes.
this recency bias in terms of like, hey, are you producing right now here in this last year or whatever that cycle might look like? It strikes me because in tech, I find that there's not this same culture, right?
Mhm.
Where you could be a senior software engineer and that could be your terminal level, right?
Mhm.
And no one would kind of bat an eyelash that, like, hey, Rick, like, why aren't you a software engineer? Why aren't you a director? Why aren't you a CTO? If you're a staff, you're just killing it at coding. You are, shipping code all the time, and that's fine. Or, if you are laid off by Google, I'm sure Microsoft would love to have you, right? I'm sure Apple would love to have you. There's hundreds, thousands of startups that would dream of picking you up, right? So they could say, hey, we have a former Google engineer, we have a
Mhm.
former, head of engineering at a startup now at our startup. It just strikes me as, and this is why I
Mhm.
wanted to chat with you about it. It just strikes me as so odd, right? That what happens to these thousands of people? And I imagine these banks, Goldman, everyone else, does this every single year. Do you just have to leave the industry entirely? does it sink you that bad? Do you have to go down a tier? Because it just seems so especially brutal when Goldman does it, and so many people want to work at Goldman. What if you finally make it and you're just part of this herd that gets called this year? Are you just screwed SOL out of the whole finance industry because Goldman has kind of put this brand on you?
Well, the positive side to working in finance is that, let's say, unlike FANG, where you may have half a dozen or plus, top tech companies that everyone wants to work for, in
Right.
finance, it is really large. I think a lot of people don't realize how big that industry is. You have everything from wealth management to money management to hedge funds to private equity to trading and so on. You have fintech. So there's so many different ways that you could kind of move your career. And
Got
so
it.
let's say, even though we were talking initially about Goldman and how it sucks, and you might, oh, you have that scarlet letter, but you can move to different areas. You may have, the background and experience to pivot into mergers and acquisitions. You can maybe pivot to going
Oh,
into private equity. Maybe you could pivot to somewhere else. And then they could say, hey, all right, it didn't work at Goldman because you were doing this, but you really do have the knowledge, the background, the credentials, and that you could kind of now go somewhere else. So I think, and tell me if I'm wrong, it just seems to me there's so many more outlets for people to go within the financial sectors. I mean, because even with finance, you have insurance, you have so many different practices that you can move into that you can make a nice living and do well. Where I think with tech, it really, and again, tell me if I'm wrong about this, all the attention really is for FANG and going into you. That's like the mecca. And if you're not there, you're nowhere. Where it is similar to Wall Street, where you want to be in the top echelon, whether JP Morgan, Bank of America, KKR, which is big private equity and so forth. But even if you can't do that, there's so many other, mid-tier, what have you. Now, you might take an ego hit. So if you go from Goldman and you go to maybe a second tier investment bank, you might say, but at least you have a job, you're still in the game.
right.
Where I think within tech, it's hard because you're fighting over just a limited 5, 6 companies. At least what I see on Blind all the time, that they want to get in there. So you're fighting everybody else, and brushing up on their elite code and doing whatever you can to make
Right.
sure that you get into there. Where with finance and Wall Street, I think it's more open, and it's also across the whole U.S. and international. So like you could actually work in different countries, in different cities, in different states. So I think you have more mobility. So as it sounded harsh when we started talking about it initially, about what do you do next if, let's say, you're laid off from a Goldman or another bank, there are lots of other opportunities for good, smart people.
Wow. No, I appreciate sharing that other part of the coin, right? Because in tech, my understanding, and having been in this industry for so long, is everyone wants to go to these 5, 6 companies because those
Mhm.
simply are the companies that pay the best, right? Within tech, it seems analogous to finance in the sense that there are many different specialties. There are many different industries, certainly many different company sizes that you could work at. But God, like the pay difference
Mhm.
from this top tier to the second tier, or God forbid, tiers below, is just so significant that you really feel it on the way down, or you really feel it on the way out, where you might have to change your entire lifestyle. Um, Maybe that's not the case, is what I'm getting from what you're saying, Jack, in finance, where maybe there's just more off ramps,
Mhm.
and that off ramp is less steep. It doesn't kick you in the butt on the way out
Yeah.
as much as it might do in tech.
Well, let me ask you, with tech, if you're in FANG, it sounds like there's like a big drop off if you go down tiers. Like how much money, let's say, for typical, let's say someone working for Amazon or Apple, I see what people are saying on Blind, that they're making 500, 600, 700, 800,000. Is that accurate, or are they hyping it, or what's the real deal that goes on?
Yeah, yeah, I'm glad you asked because part of it is a bit of a hype, right? Where you're pumping it up. And
Mhm,
that's largely because if you look at the stock market, most of the gains in the biggest 500 companies, the S&P 500, it's pretty much these seven companies, right? The so-called
mhm,
Magnificent Seven. And they're primarily tech companies. There's the Amazons, the Nvidias, the Metas. And so that's why those end up being the 7 or 10 companies that everyone in tech wants to work at, because stock-based compensation is such a big part of compensation packages when you're looking at your TC, your total compensation, right? So a lot of folks, their initial grant in their offer letter might be something to the effect of, hey, your base salary is going to be 200K,
mhm.
and you are going to get a stock package worth 500K split up over 4 years. So your first year, technically on paper, your compensation is actually 200 plus the 125, 325,000. But what ends up happening is, as your stock gets released to you, as it vests over time, the stock value, the share price actually trades up because they're innovating, they're coming up with all these new technologies and products and services, where the company is becoming more valuable. So that $125,000 stock grant that you got every year ends up being worth 200, 300, 400. And so your total compensation ends up being 600, 700K every single year, when on paper, it was just supposed to be that 125. And that big drop in terms of that high level to, a startup is especially extreme, because it's all about the liquidity, right? Where if you work at Meta, you get that stock, you can sell it immediately as it vests, because you can go to Fidelity, you can go to E-Trade, you can go to, Merrill Lynch, Robinhood, and buy Meta right now today. Everyone knows exactly what the share price is going to be. There's a market where you're going to be able to sell it. But if you work at these startups, even these huge companies that are about to go public, there's that liquid market doesn't exist, right? So you have basically lottery tickets where you can't necessarily sell your shares. If you do try to sell your shares, you're not necessarily sure what you can get for them. There's all these, second place marketplaces, and we've had them on the show, right? Like Equity or Hive, but that market is opaque, right? People might not necessarily want to buy it, or you might have to wait 4, 5, 7, 10 years even for that liquidity event to happen, whether it's a secondary sale of shares or that eventual IPO or an acquisition. And so you could be sitting on a lot of paper cash. That recruiter, that offer letter will say at a startup, hey, you're going to get 100,000 shares. And you're like, great, but you can't sell it, right? Or you have to sell it at a discount if you can even sell it at all. And so that's kind of that big drop. It really comes down to that stock-based compensation. You know, I've been on the other side where on paper my stock compensation was supposed to be 100K, and the company actually does poorly. The shares trade down, and so you're actually seeing a pay cut.
Mm.
It's not something that anyone at the company likes, but I've been there too also.
So let me just understand it. See, I thought that people would come in at a higher base, but it sounds like, is this on average, or just when you said about like 125, is that like a young kid starting out, or is that just kind of a basic entry point? But then on top of that 125, as you mentioned, you'll have stock, you have options, grants, and things of that nature that could, and this is a little tease because we're going to have another podcast talking about Nvidia. So just to get a little tease about how much money people could make if they're at the right company and they have the right stock. So if you're in the right company and is doing well and your stock appreciates, that 125 and the base will be like almost chump change compared to what you're going to get on the appreciation of your stock, right? So is it almost like you guys are gambling on the tech side, where you're gambling that you find that right company, and maybe that's why everyone wants to go to FANG, because they feel like the stock's always going to go up, and if it always goes up and you have a lot of that stock, you're going to be freaking rich. Is that the game? Is that how it works?
A little bit,
Sort
right?
of, sort
I
of.
mean, it's less of a
Yeah,
game in the sense that Meta,
right.
Amazon, the volatility is not quite there. It's not a meme stock. So,
Yeah,
for with some certainty,
right.
the variation isn't going to be that crazy, right? These typical offer letters at these large companies, when they're describing your compensation, most base salaries are going to be the same, right? If you're going to be a senior, professional on the business side or a software engineer, it might be something like 200 to 250, and that band is pretty, tight. It's really the stock compensation that's different, right? So there's certain roles like engineering tech side, they might earn more stock than someone that is, on the HR side or on the marketing side. And they vest over a certain period. So you'll get something in your offer letter that says, $400,000, but it vests over 4 years. And so you do a little bit of math and you end up saying, oh, that's about $100,000 a year.
Mhm.
And so they'll give you $100,000 worth of stock, whatever that might be. And it's usually based on a certain date after you join, or a certain point of time in the year, where they'll like kind of take a snapshot of what is our stock trading on that day, and then give you that many shares. And you just got to hope, oh, well, I got 50 shares. Oh, lucky for me, our stock actually went up. And so, I my 100K of stock is now worth 120 or 200 or whatever that might be.
Rick, what I find so interesting and funny is that if you asked any person at random about tech versus finance/Wall Street, they would say, "Oh, the Wall Streeters are the gamblers. They're the ones that are
Yeah.
taking the risk." But the more I'm hearing you talk about it, it's different, because let's say you're at a Barclays, let's say you're at a Deutsche Bank, or good firms, but not that, let's say Goldman and Morgan Stanley or JP Morgan or the big
Right.
PE shop, you'll get a really nice base, and then you get a large bonus. So most of the money for people who work on Wall Street and finance, it's the bonus time. That's like where you get kind of what you're talking about, how you have the stock. They get little stock for the most part. Maybe some big executives get some stock, but it's really more of the bonus. So you're working the whole year hoping you'll get your bonus. In fact, a lot of people who work on Wall Street, their salary is just to kind of pay the bills and all that. But
Yeah.
then they wait for the end of the year where you get that big bonus. And then you're like, yeah. And the gamble is that you could have a bad year, but you're crushing it all along. Like, think about what's going on now in the market, is that everything is going up, 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 up. All of a sudden, Nvidia is going down, the stocks are going down. So you could have this great year, and then all of a sudden, not so great. And now your bonus could be what they call a donut or zero or a
Zero.
bagel,
Wow.
meaning like literally you could have been crushing it almost all year. And then in like November or early December, things go bad, and like, oh, sorry, Jack, sorry, Rick. Yeah, you got a bagel. You got like a zero on your bonus, or very little bonus. So that's gambling. That's crazy gambling. You're hoping that you're going to hold your job and then get a good bonus. On your side, with the tech side, you got to hope that the company you're with, your equity is good, and nothing goes wrong with your company, because then you can say, oh my God, all right, my base is all right, but now whatever is going wrong with my company, that RSU, what would you call it? Like RSUs, restricted unit?
Right.
What's the term for it? Like, so if you have restricted
Um,
stock, it's just restricted.
restricted
uh,
stock unit, RSU.
So you have RSUs, but like if your company all of a sudden something goes wrong, then you're skunked too, right? You did all that hard work and maybe you don't have much to show for it. So I guess both sides, you're gambling
Yes.
on what you right, like how it's going to play out.
Well, the PR
Yeah,
person in
yeah,
me was saying, no, it's not a gamble
mm,
because it's to align incentives, right?
yeah.
Where we're in the same company together. We all want the company to do well. We're getting, shares of the company because we're going to be literally part owners
Mhm,
of the company. Um, and so that's to reward you for the hard work. And it's almost kind of like a profit sharing where it seems like on Wall Street, you're getting hold card cash, right?
mhm,
For your bonus. In tech, that cash bonus is less frequent. Some companies do have it in addition to the stock and your base salary, but it's primarily stock, right? So there's almost two kind of gambles. If you're working at a startup, you're getting stock options instead
mhm,
of restricted stock units for the most part. And so a stock option, you actually have to buy them with your own money. And it might be, at a certain strike price at a certain price. And you're hoping that one, the price that I'm allowed to buy those shares at is low enough or lower than what the eventual value might be
mhm.
if it goes, IPO or whatever. And then second, that the company eventually hits that milestone where someone wants to buy the stock or the stock becomes liquid. Because, I've been at companies where I buy the stock, my stock for my stock options, and I'm just sitting on the stock. I don't really have a good way to sell it.
Mm,
The value might even go down because, in 2020, 2021, a lot of tech was flying high. These companies were raising at these crazy valuations. And so on paper, the stock went up, but now we're in 2024. That might not be the case. There's no liquid market. So you're kind of making this guess out there. But, what if I had joined in 2021, got these stock options that were priced really, really high, and now I have to wait and hope that the company will eventually get to those same levels or grow into that valuation for my stock options to be worth or something. Or alternatively, you know, you work at, a not so cool public company, the stock goes down. And so I was promised 100K a year, but now it's, the stock gets halved and now I actually have 50K in stock, and so it's almost like great. I got a pay cut there.
You know, this opens up a door. Let me just kind of think this through out loud, because
Yeah,
I'm blind on the blind platform, and I would encourage anybody who is going to watch this when we put it on different social media channels to check it out, because it's interesting to learn what goes on behind the scenes in different industries and different sectors. So that, like, what I see is this. Let's say within the finance area, here's kind of a drawback, I think, or maybe a little pitfall, is that let's say you're a stockbroker, let's say you're a wealth manager, let's say you're a money manager, what have you. The incentives is that you need to sell more. You need to, you need to sell more. You have to do certain things. You have to push the envelope. But by doing so, we see on a regular basis, like, every probably once a month or so, some big, like, oh my God, here's what happened, this terrible thing, whether it's Sam Bankman-Fried with FTX, or it could be something else. And because you get big bonuses based upon your productivity, human nature, you're going to push the envelope. Let's just take a very simple example. Let's say you're a stockbroker, and like, you know, insurance rates are going up, mortgage rates are going up, everything, food is going up. You're like, oh, I need some extra money. So maybe I'm going to tell Rick, this stock you bought, let's get you out of this stock and put you in this stock. So now the broker will get some more commission money
Right.
because they're churning your account a little bit because they got to come up. And that's just one little example of it. So that on the finance Wall Street side, it's I don't know if the same thing happens in tech, because tech is seems to me kind of like you can't fudge the numbers, or you can't, put, but like on Wall Street, you could do certain things that aren't too cool, and you're just doing it to goose up your total package.
Yeah, I'm trying to figure out if there's an analog in tech, right? Obviously, we have
Mm,
tech sales where you
yeah.
could structure a deal in a way that gives that sales rep more commission up front,
Mm,
or something like that. But if you're a marketing professional, or let's say a PR guy like me, right? I get that stock no matter what. The kind of cause and effect in my day-to-day work is kind of less clear, right? Obviously, as a marketer, as a PR person, you know, as an engineer, your work, the code that you're producing ends up being the product that we can sell. Great. The PR gets that publicity and hopefully drives more sales, right? Draws more qualified leads by marketing. Um, but there's less of an impact in terms of how I can kind of goose up my own numbers, right? Because it's almost at a company level.
yeah.
It almost becomes like you have to like massively coordinate, and obviously that's what the company wants, right? Like everyone wants you all to put in those crazy work hours so that everyone's shares can be valuable. You almost have kind of this like collective action problem, right? Where you really have to get everyone to like not rest and vest, to like work really hard rather than kind of more immediate uh,
Let me run one
impact.
last thing by you. Tell me if this makes sense, right? Where do you think, with the ascension of AI, that we already have fintech, but do you think ultimately you're going to see the convergence of tech? And it's here already, but like to take it to the next level, where the convergence between AI and finance is going to kind of bridge the gap and maybe blur some of the boundaries, because you're already seeing, AI using in just trading stocks, like Renaissance Capital, like one of the, best, hedge funds out there. The guy who ran it for years passed away just recently, and they they were just doing all like AI models and numbers. It wasn't like human beings saying buy, sell, buy, sell. It was all
Right.
programmed. And as AI keeps getting better and better, do you think you're going to find this where all of a sudden, is it finance? Is it tech? Is it like what, where it gets so infused, whether it's doing something for a M&A deal, or doing something, to buy and sell stock and what have you, to trade stock, that it's just going to get all fuzzy. What do you think?
My bet is if we're going to see some kind of outsized impact
Hmm.
as a result of AI, it's going to be in the tech industry, because those folks are kind of the folks that are more, you know, kind of on that bleeding edge
Hmm.
in terms of willing to adopt new technologies. Like, I wouldn't be surprised if someone right now out there in the world, and maybe it's one of our listeners, but
Hmm.
they're going to start a new AI startup that's going to be $1 billion, a unicorn startup, and it's going to have like 5 employees, because they're going to use AI to code, they're going to use AI to create all the marketing materials, they're going to use AI to create the design, where really they just need 4 or 5, maybe even one person to come up with that killer idea, that
Hmm.
business model. um, and so if you think about that hypothetical 5-person, 20-person startup, and you have the stock options. Well, now you're dividing that pie of the company to fewer people. And so these like rewards, you get to keep more of that in your pocket. And so I could see that might be the future in terms of where AI is going to get really infused. Now you don't need to have all these, software engineers that I have to pay 600, 700K in terms of stock. I'm diluting myself, issuing all this stock to do the stock based compensation, right? Now there's fewer people. And as a founder, as an executive, I get to keep more stock, get less kind of diluted. That seems to me the future, and maybe
Mm.
we're only a few years away from that.
And it's so different within finance and Wall Street because you need such a bigger infrastructure. You need to
Right.
have compliance people, auditors, risk managers, and you could go on and
The
on.
lawyer, right.
Lawyers, because you're dealing with people's money and you're dealing with people's money. Like, okay, you could have a piece of tech, right? But okay, you're not going to lose grandma's life savings with a piece of tech, but you could on Wall Street. So you have so many layers and so many people. So yeah, you probably AI could do a lot to, cut jobs or what have you, but not to the same extent of what you're talking about, having that, 2, 3 person shop that could be a unicorn because yeah, it's so regulated that, and maybe one day they are going to regulate AI more so than what's going on now. But yeah, with Wall Street, and maybe to go back to like an earlier question about the different jobs, because there are so many different jobs there. There's so many. So if let's say you lost your job at Goldman and maybe you're not a banker, you lost your job, but you're a risk manager, you could maybe go into something else, another risk management job. You could go into maybe, I'm making this up, like an audit role or what have you. So there are all
Right.
sorts of different areas that you could kind of pivot into, because it's regulated and because you need all these different people. So they hire a lot of people, and it's it's going to be interesting to see how it plays out because things are moving fast. So like it's I don't know about you, but it's really exciting to see like how this is all playing out and where this is going to lead to.
Yeah, I think there's, at least to me,
Mhm.
there's been no killer app in AI yet, at least that I've seen. Maybe like a lot of, chat GPT and perplexity and Copilot, to me, and maybe this is just my
Mhm.
naive take on things, is they almost seem like cool cocktail party tricks, right? Like I haven't seen someone really go out and say, hey, this is the new killer thing that even my mom, who doesn't use any
Mhm.
tech, is going to be wowed by and is going to want to use, in the same way that we saw with the internet or the iPhone. I'm waiting for that moment, and I think that's going to be the future, and I don't think we're there yet.
Well, isn't that the big thing that now people are concerned about? And one of the reasons why, you know, you know, tech is kind of dropping a little bit because they're looking at the numbers and seeing how many billions are being spent on AI and machine learning, but then you're not seeing the accompanying revenue and profits from it. So after a while, you're going to see that imbalance and somehow you have to get it back together, or it may say, hey, maybe a lot of this is too much of a hype cycle and it has to bring it down to earth. So yeah, you're right. Cause like there isn't, we can't really point to 1, 2, 3 things and say, oh my God, look at this. We have 3 people doing this unicorn and it's everybody now it's in their house and do it, right? It's not really there. Um, and for now, when you're using all these AI products, most of it is for free, but maybe they're going to just have to charge a whole lot of money, and maybe that's what's going to happen moving forward. I don't know.
Yeah, I think that's it. Well, thanks for breaking down
Uh-huh.
the state of Wall Street for us, Jack, and what these kind of annual performance
Mm.
related layoffs look like, and what it actually means for those people that are affected, and how that affects their compensation packages.
Yeah, it's unfortunate that we have to talk about the culling and the low performers, but you know what?
Right.
This is what it is. And I think the value that you and I add is by giving some color and context to what's going on. Because oftentimes, when, you look at the media, it's just like, look at that. Great. Sometimes you just have to have this calm, nuanced conversation where you can really delve into, hey, what is going on? Let's say in this conversation in particular, what's going on within tech, what's going on in finance, what's going on Wall Street in a measured way. So people who are trying to navigate their careers may say, you know what? I- Hmm, listen to Jack and Rick. I think the tech area is really good. Maybe how can I kind of cross over and vice versa? So I think it opens up ideas, but particularly when it's a tough white collar market where we are now for finding jobs, I think that's the value that we offer in part is to show, hey, here are different things you could take a look at that maybe you didn't even know existed. And if you lost your job and looking for a new one, hey, maybe you could go into finance, go into Wall Street, go where, what have you. So we'll keep, doing these kind of shows so that, we could help people, navigate their careers, grow their careers, make more money, and build a future for themselves.